What if the common wisdom about chart patterns is fundamentally flawed? Perhaps they aren't working for you in the way you were taught. You've likely memorized countless shapes like flags and triangles, diligently marking them on your charts. Yet, you keep falling into the same traps, seeing your trades reverse right into your stop loss. The real issue lies not in the visual geometry you're observing, but in failing to interpret the underlying market auction. A pattern isn't just a drawing. Instead, it's a visible record of a continuous battle between buyers pushing for higher prices and sellers aiming for lower ones. By understanding this struggle, who is caught off guard, who is forced to exit, and where momentum is building, you can move beyond mere speculation. This deeper insight allows you to truly understand market behavior rather than just guessing based on shapes. In the coming moments, I'll guide you through 6 powerful price patterns, revealing the true dynamics happening beneath their surface. We'll focus not on simple shapes, but on the intricate market mechanics driving them. Our 6th pattern, often overlooked by many traders, holds immense potential. However, to grasp its significance, you must first understand the foundational principles behind the initial 5. Let's start from the very beginning. Before we delve into any specific pattern, it's crucial to comprehend the fundamental engine that powers all market movements. Every single candle you see on your chart is a result of 2 primary market forces at play. On one side, you have patient traders who place limit orders, waiting for their price. They provide essential liquidity, much like inventory on a shelf. Conversely, impatient traders execute market orders immediately, consuming that available liquidity. They are the eager shoppers, grabbing items from the shelf right now. When the volume of impatient orders overwhelms the patient ones at a specific price, the market price shifts. That's the core mechanism, but there's also a third force. However, there exists a crucial third influence, one that profoundly alters the entire dynamic of the market. These are known as stop orders. They remain dormant, poised, until the price point they specify is finally reached. Once activated, a stop order instantly converts into a market order, necessitating an immediate and unavoidable execution without any discretion. The significant aspect, when one stop order triggers, it often propels price into the next, initiating a chain reaction. This creates a cascading effect, a phenomenon well documented by regulators and validated by real market research, not just theory. These mechanical stop cascades are, in fact, the underlying energy driving many of the chart patterns we are about to explore. Another vital piece of this market puzzle involves where these numerous orders tend to accumulate, consistently at easily identifiable levels. This includes previous swing highs, swing lows, and even significant round numbers. Their clustering there is no mere chance. This inherent accumulation of resting liquidity at those precise prices is precisely why concepts like support and resistance effectively operate. With this understanding of the market's core mechanics, let's now examine its manifestations, beginning with our first pattern, the flag. Most traders are taught that a flag simply represents a small channel following a strong directional move, which is a highly superficial description. Though technically accurate, this definition neglects its true function. A flag is the market's question. Is there enough supply to reverse this move? The consistent answer, however, is no. Following a powerful, rapid price impulse, the market invariably experiences a temporary pullback. This retracement attracts both new sellers and profit takers, but crucially, their combined efforts are insufficient to push the price significantly lower. The critical insight is that if these sellers fail to drive the price down substantially, the selling activity is effectively being absorbed. This absorption is evident through specific candlestick behaviors. Candles become smaller, pullbacks shallower, and the overall range tightens. Imagine the market functioning like a sponge, continuously soaking up every single sell order that enters the fray. Crucially, this market sponge never becomes saturated, indicating a relentless and underlying demand. This sustained absorption process is what we call compression, a state that inherently stores significant energy. When price finally breaks above the flag's upper boundary, two powerful forces are simultaneously unleashed. Firstly, new buyers immediately enter, generating a fresh wave of momentum to push the price higher. Secondly, and perhaps more importantly, the trapped shorts are compelled to cover their positions, leading to forced buy-to-close orders. These mandatory buy orders act like rocket fuel, providing non-negotiable buying pressure that dramatically accelerates the price movement. However, it is vital to scrutinize the quality of this breakout. You want to see a strong close with a wide candle body near its high. This signifies genuine acceptance of the higher prices, as opposed to a mere wick that pokes through but then closes back inside, which indicates rejection. Recognizing this key distinction will fundamentally change how you perceive and interpret all future breakouts. But what if a flag pattern breaks down instead of up, revealing that the seemingly dominant side wasn't dominant at all? This failure isn't a loss, it's invaluable information. This insight also connects to a more crucial pattern we'll explore later. But first, let's introduce our second pattern, the rectangle. Having just examined the flag pattern, our focus now shifts to the second crucial formation, the rectangle. While a flag suggests insufficient supply to reverse, a rectangle presents a different market dynamic where buyers and sellers are in a state of consensus. This means market participants have discovered a comfortable zone for two-way trading, with price moving between defined highs and lows. The price repeatedly pushes to the upper limit, meets supply, then retreats, only to drop to the lower boundary, find demand, and bounce back up. This constant back and forth signifies a period of perfect balance. Neither the bullish nor the bearish side is gaining a definitive upper hand. Yet, equilibrium is never permanent. When this balance eventually breaks, you are witnessing a significant liquidity event unfold. This liquidity event implies one of two key scenarios has occurred at the rectangle's precise boundary. Either the existing resting orders at that edge were completely consumed, with aggressive market orders eating through them faster than they could be replenished. Alternatively, the providers of limit orders simply withdrew their bids or offers, effectively creating a sudden void in the order book. Regardless of the specific cause, the outcome remains consistent. Price effortlessly moves beyond the boundary because there's nothing left to impede its path. However, the true intrigue of rectangles often emerges during the subsequent retest. After a breakout, price frequently returns to the previously breached level. Many traders panic at this site, questioning, is it failing? But a high-quality retest actually provides powerful proof of validity. It serves as the market's clear confirmation that the old resistance has now firmly transitioned into new support, or vice versa. You want to observe distinct rejection wicks, indicating price attempted to re-enter the old range, but was firmly pushed away, closing strongly on the new side as trapped sellers become forced buyers. This strong closeback above the level provides undeniable proof of the market's conviction. It's the market's definitive statement that the former resistance has now completely converted into robust support. It's as if the market itself is declaring, "We attempted to revert, but we cannot. This is now the established value." But consider those traders who were actively betting against the range, consistently selling at its upper boundary. Once you grasp the fate of positions after a genuine breakout, the resilience of retests becomes clear. Indeed, these trapped sellers are then forced into becoming buyers, and their subsequent exits powerfully fuel the continuation of the trend. However, a failed breakout, where price briefly pushes through only to snap back within the original range, is not mere market noise. Instead, such a move is a deliberate trap designed to ensnare unwary participants. For those breakout traders who just entered, their stop-loss orders then become the very fuel that powers the ensuing reversal. Notice how this reveals the same fundamental four-part market anatomy, concealed within an entirely different geometric pattern. Triangles. Forget the simple image of converging lines. A triangle fundamentally represents increasing pressure against a significant barrier. Consider the ascending triangle, characterized by a flat resistance level and steadily rising lower bounds. This formation reveals that the flat top signifies a well-established supply zone, where sellers consistently appear at the same price. Yet, on the demand side, buyers are growing more assertive, pushing bids higher with each attempt, causing the lows to continually climb. The underlying pressure intensifies, weakening the barrier despite the price not having breached it yet. Conversely, in a descending triangle, we observe a stable support level paired with progressively lower peak prices. Sellers become increasingly eager, pushing supply earlier and repeatedly testing the demand at the lower boundary. The crucial question for any triangle formation is whether true price compression is occurring or if it's simply a period of inactivity. Genuine compression manifests as smaller price swings and shorter wicks, indicating the market is tightening like a wound spring, accumulating energy. A lazy triangle, however, displays wide swings and long wicks without clear directional pressure, suggesting aimless, choppy movement rather than energy storage. When the boundary eventually breaks, the momentum is fueled by edge defenders, traders who bet against the ceiling or floor. Their forced exits, triggered by stop losses, can then cascade, creating significant directional momentum. Yet, many traders overlook that triangles frequently fail, leading to deceptive false breakouts. A failed breakout, like a wick above the ceiling that quickly retreats, signals that the perceived dominant side was an illusion. When such a reversal occurs, it can be extremely sharp because both breakout traders and initial edge defenders are caught on the wrong side, creating maximum forced liquidation. While most pattern guides conclude here, the next pattern fundamentally redefines our understanding of reversals: the head and shoulders. This century-old pattern persists because it narrates a complete story, not just of three peaks, but of fading demand. Beginning with the left shoulder, the trend remains robust as buyers achieve a new high before a slight pullback, signaling bull dominance. However, a fascinating counterintuitive scenario arises. What if the head and shoulders neckline is breached only for the price to quickly reclaim it? What if the price then surges even higher, surpassing the peak of the right shoulder itself? In such cases, the pattern hasn't simply failed, it has uncovered a surge of unexpected underlying demand. This development leaves short sellers completely trapped, and their forced covering then acts as powerful fuel for an upward move. Indeed, some of the most robust, bullish rallies I've ever observed have emerged from these very failed head and shoulders formations. The market's powerful reaction here completely defied the prevailing crowd sentiment, moving in the opposite direction. Our next pattern reveals the market's purest memory structure: the double top and its inverse, the double bottom. These formations are crucial because they highlight how the exact same price area can trigger an identical reaction, not just once, but repeatedly. A double top occurs when price achieves a peak, pulls back, then returns to that identical high point only to be rejected once more. Mechanically, this signifies that at that price level, supply is strong enough to absorb all buying pressure, effectively creating a ceiling. Conversely, the double bottom is its mirror image. Price repeatedly finds strong support at a low, indicating consistent demand. Crucially, the confirmation for these patterns isn't merely the second peak or trough, but rather the break of their midpoint, known as the neckline. In a double top, a break below the swing, low between the two peaks, signals that buyers who previously held that mid-level have capitulated. Consequently, traders who entered at the second top become completely trapped, and their forced stop-loss exits intensify the downward momentum. The individuals who purchased at that second peak find themselves completely stuck, and their mandatory stop-loss orders only fuel the price decline. However, there's a crucial understanding regarding double patterns. A double top that fails to confirm can actually be a very strong bullish indicator. Imagine this scenario. Price initially forms a double top, and then the neckline is breached, prompting many short sellers to enter the market. But unexpectedly, the price recovers, moves back above the neckline, and eventually surpasses the levels of both previous peaks. This failed breakdown completely ensnared every short trader who had entered the market anticipating a further drop. Their need to cover positions translates into forced buying, and if genuine demand supports this upward movement, the breakout intensifies rapidly. Studies on this specific phenomenon, often called a busted double top, reveal that the subsequent reversal can be far more substantial than the pattern's initial projection. Now, recalling my initial promise, we're approaching a concept that will fundamentally transform how you interpret trading charts. We're introducing pattern number 6, which holds the key to a complete paradigm shift, the concept of failed breakouts. Every chart pattern we've discussed so far possesses a mode of failure. For instance, flags can break in the opposite direction, rectangles can mislead, and triangles or head and shoulders patterns can reverse. Typically, most traders perceive these pattern failures simply as losses, attributing them to bad luck, or concluding that the pattern just didn't perform. But what if I proposed that the failure itself is actually the crucial signal? A failed breakout essentially represents a market's unsuccessful attempt to accept new price levels. Price pushed past a defined boundary, be it a range limit, a trend line, or a neckline, testing a new value, only for the market to reject it, signaling, "Not here, not now." Mechanically, this occurs either because aggressive buying hit deeper supply, or liquidity providers temporarily withdrew then re-entered, or, most frequently, the breakout was merely stop-loss driven without genuine participation. The price then retreats, showing the market's verdict, and crucially, all those breakout traders who just entered are now trapped with their stops inside the original structure. The market's verdict is clear as price retreats back inside the previous boundary. The auction has definitively spoken. Crucially, every single trader who entered on that breakout is now caught in a precarious position. Their protective stop-loss orders are now located inside the very structure they believed they had broken out of. When these stops inevitably trigger, a powerful domino effect begins to unfold across the market. Ironically, the same traders who initially propelled the breakout now become the unexpected fuel for the market's reversal. Their forced exits, designed to limit losses, instead generate significant momentum for the opposing market direction. This fundamental dynamic is what I call the meta pattern, and it consistently applies to every chart pattern we've discussed. For example, a busted flag swiftly becomes a reversal trade, while a failed triangle often leads to a sharp move in the opposite direction. A busted double top, surprisingly, can even become one of the market's strongest bullish signals. Once you grasp this concept deeply, You transcend being merely a pattern trader. You become an intent trader. Your focus shifts from simply matching textbook shapes to discerning what the market is truly attempting to achieve and whether it's succeeding or faltering. As I mentioned earlier, market failure is not a setback. Rather, it provides invaluable, privileged information. A clean failure reveals more than a clean success by exposing hidden liquidity and significant positioning imbalances, highlighting trapped traders. This condition, where participants are caught on the wrong side, represents the most exploitable opportunity within any market. This situation, where market participants are positioned incorrectly, truly represents the most profitable condition you can find in any market environment. Now, let's bring all these ideas together. You don't actually need to memorize numerous chart patterns. Instead, focus on internalizing just three fundamental questions. The first question to ask is, where is the concentrated liquidity likely located? Observe your chart for obvious swing highs, swing lows, and significant round numbers. These points act as magnets, attracting a cluster of various orders: limit, stop, and conditional. The market naturally gravitates towards these levels because that's where collective decisions are made. Secondly, consider who will be compelled to act if the price reaches a certain point. If price breaches a resistance level, whose stop orders are just below it? Conversely, if it sweeps below support, who will be forced out of their positions? Will these forced exits generate enough momentum to sustain the move, or merely enough to trigger a trap? The third crucial question is the market currently in a state of balance or undergoing price discovery? Balance implies active two-way trading where both buyers and sellers are present, causing price to oscillate. Price discovery, however, signifies that one side has decisively overpowered the other, leading to directional price movement with consistent closes in the same direction. These three questions are universally applicable across any chart, time frame, or market. Their power comes not from recognizing shapes, but from understanding the underlying auction process. Here's the complete mental model that unifies everything. Every market progresses through a consistent cycle of balance, building pressure, testing boundaries, followed by either acceptance or rejection. This leads to expansion, then either exhaustion or continuation, before returning to balance. Every pattern we've discussed today is simply a unique manifestation of this continuous loop. For instance, flags represent expansion, followed by a controlled balance, then continuation. Rectangles signify balance, then acceptance, and finally price discovery. Triangles illustrate a tightening balance with pressure against a boundary, culminating in resolution. Head and shoulders patterns indicate exhaustion, a failed continuation, and then a reversal. Doubles show a failed extreme, followed by acceptance in the opposite direction. Failed breakouts are simply rejected attempts at acceptance, leading to a reversal and expansion. Ultimately, all these varied chart formations are simply diverse manifestations of the very same underlying market engine. Grasping this core principle will fundamentally alter how you interpret price charts forever. However, let's be entirely frank for a moment. A single viewing of this video won't instantly transform you into a pattern master. While understanding the underlying mechanisms is crucial, true internalization demands consistent practice and significant screen time. Nevertheless, you now possess something invaluable that you lacked just 20 minutes ago: a universally applicable analytical framework. Your approach isn't about memorizing distinct shapes, but rather about asking three fundamental questions. Instead of questioning if a pattern looks right, you'll now instinctively inquire, what is the market's true intention here? The next time a flag pattern emerges, you won't merely perceive a channel, You'll discern absorption and trapped positions. You'll recognize the immense compression building poised for a powerful release. When a pattern inevitably fails, and it will happen, you won't experience frustration. Instead, you'll view it as invaluable, privileged information. This profound shift from merely observing shapes to truly deciphering market intent will fundamentally alter your trading journey. It won't happen overnight, but this transformation will be a lasting, permanent change. Therefore, do not watch this content just once. Make sure to save it and revisit it after your next trading session. I assure you, a second viewing will offer entirely new insights. Until our next encounter, always remember to interpret the auction. I'll see you then. Remain disciplined.